Good evening and welcome to an ACY Securities webinar. Tonight, I am going to be covering a few different things. It's all about getting started with financial markets. So if you haven't partaken in financial markets or investing of any kind, then this is probably the perfect place for you to start your educational journey. To get started, my name is Alistair Schultz. I am the Chief Market Analyst for ACY Securities, and I have about 15 years, perhaps even a little bit longer than that, of experience in the financial markets, including time spent on the floors of New York trading there. Now, my experience has traveled beyond that, and I've ended up in brokers, like you see I am now, but I am still actively trading as my main source of income. So we will get started with it. There are a few things to cover off first, or check the boxes off. The first thing of which is a risk disclosure warning. Now, obviously, trading carries a high level of risk, just like any investment does, regardless whether that be housing or even in property of commercial kinds, and naturally moving into stocks and other things like that. So it's always important that regardless of what the investment is, that you check what your risk tolerances really are, understand your own trading experience and seek help if you need it. And obviously have a goal for your investment objectives. You don't want to just be willy-nilly trading. So to get started with tonight's stuff, it is all about what goes into the start, or at least putting you on the path for a journey about learning to trade. So the most fundamental point of this is to actually start off with an understanding of what's involved in the market. When stripped back to the bare basics, the market is really just an auction. It involves one party trying to sell something and another party or a number of parties all competing with each other to try and buy what is offered for sale. In the past, auctions would have occurred in the open outcry of a pit exchange. So if you were on the trading floors of New York back in the early 90s, you would have experienced this. You perhaps may have even seen it in movies. Now, what generally happens in this sort of circumstance would be that people would be holding their tickets in their hand, calling out prices, trying to get the best value that they can for their position. Over the past sort of 30 years, we've seen venues have been replaced by electronic trading. So the first of these to sort of migrate to it was the London Stock Exchange, who moved to electronic trading in 1986. We saw the Borsa Italiana, Italy's stock market, move to electronic trading in about 1994. From there, we've moved all the way through, and eventually some of the big ones like the International Petroleum Exchange moved in about 2005, and eventually the NYMEX, or the New York Mercantile Exchange, moved into 2006. So we have a variety of things, and these days you will find that almost all of it is done via electronics. But regardless of that sort of factor, it is still the same process behind the scenes. The earlier you understand the supply and demand principles that come with the idea of trading in the market will help you with that auction process when it comes to the digital element. So in the reality, in the open outcry environment, registered traders would be working for brokerage firms, and they would usually be providing a buy or sell service for their clients. Clients were also individuals. You'd get companies, institutions with sophisticated levels of understanding in financial affairs, and they would all be trading in the market on that trading floor. With electronic trading, it's really opened up the door to be accessible to a much wider audience. All the original participants are still involved, but now we're getting brokerage companies providing trading accounts to almost anyone who can deposit money to a trust account. So this has attracted a large pool of participants whose level of financial sophistication may not necessarily be up to the higher standard of some of the others. Most of these participants really had little exposure to trading, and that's why you do see some success rates not being quite on par. But the reality of that, having high failure rates, applies to any business, and provided you treat your trading like a business, then you'll have the same sort of prospects for success. Now, if you were to, what do sort of traders really see? I want you to sort of imagine yourself as a single trader sitting in front of your computer screen, watching prices move on your chart. What is it that you're really seeing? Many traders sort of forget about what's happening in the background, and they think that just by tracking the movement of price, others will have read they are observing a measure of fear and greed, and you will sometimes hear of other sort of indices where it is about the supply and demand. The market in its essence is an auction, like I said before. Most people understand how an auction process works. So if you apply it to something that's tangible, like a house, multiple bidders competing against one another to arrive at the highest price. that one of the bidders is really willing to pay. The market's auction process is similar, but it's a little bit more dynamic. It involves a large number of buyer and sellers, and it provides a constantly changing cycle of supply and demand. So if there are more buyers than sellers, your demand will naturally be higher than the supply and your price will rise. If there are more sellers than buyers, then the supply rises against the demand and your price will fall. So let's consider the idea of, what are we watching when we are studying a chart looking for an opportunity to trade? The reality of this is that you are monitoring the change in price that is occurring because of changes in supply and demand. The distinction might not seem all that significant, but it is essential to understand if you're going to be participating in the financial markets and particularly that auction process. If you believe you are just looking at a graph and don't really understand what's going on behind the scenes, you may not understand some of the other things that happen during the trading process. And this can apply to many different elements of trading. The common misconceptions about stop losses are a big one that sort of go there and why they don't always get respected. This tends to be a common issue for your inexperienced traders. So to really consider that idea about how participants are involved and how people actually consider trading, each person is a individual. So they might have a unique way or perspective of how they look at the world. And this applies to trading. When I've sat down next on the trading floor, quite often the person to my left and the person to my right trade completely different to the way that I do. And naturally, I have found that with a variety of traders across the globe, it is almost impossible to try and replicate or copy what someone else is doing exactly because of the way that we might interpret what we're seeing on the chart. So whilst that might be the case, and what the game of the trader is to make profits and losses by forming a theory about whether price will move higher or lower and then testing that theory by placing a trade. There are as many ways to really formulate that theory as there are traders, but you can break it down into a couple of very different broad approaches. The first of these sort of approaches is what we consider a technical approach. We would look at the idea that technical traders use mathematical models to make sense of the market's price movements. They can fall into several different groups though. So you can have the models of price action, which is probably the most basic form of technical analysis, and it involves examining price charts and forming a theory based on the patterns of individual price bars or the pattern formed by a series of candles. When you look at the next step, you've got indicators, and indicators are known to all technical traders, and they use defined equations to create a secondary chart that attempts to create a more predictive view of the market. You then would have your support and resistance style, and traders can identify historical prices where it has seemed to stop and reverse to form resistance or support. Areas of support and resistance can be identifiable and identified. Support or resistance levels may even be important when price sort of moves in an area on multiple occasions in the future. Now, generally, when we sort of look at all of these sort of things, they do fall into something that we consider to be a lagging indicator. We're using previous data or old data to try and forecast what we might anticipate in the future. Now, when we think about it, technical traders do fall into two sort of categories, and even by extension a third. The systematic trader is someone who will create a well-defined system or a set of trading rules that will allow them to sort of look at the trading results based on their past data, and it helps assume that the results will be repeatable in the future. So at the moment, you might be seeing a little bit of information around this when it comes to the idea of people comparing what has happened during 2008 in the GFC, what's happened in the Great Depression, and other recessions for that matter, compared to what we're seeing now. The idea of a technical trader would be that they are looking particularly at the chart and the price points that occurred during those times to try and find something that might be repeatable or actionable for them. You then might also get a different type of technical trader, which is what we would call a discretionary trader. They would monitor price charts to sort of identify patterns that they predict will be profitable. The technical traders using a discretionary approach will have more difficulty pointing to a theoretical history to support potential future results. But on the other hand, they're a lot more flexible and they can adapt their approach to changing market conditions as they go along. Now, the third extension of this happens to be algorithmic trading. And so whilst The technical ones are using an idea of a mathematical approach or a pattern recognition style of approach. Algorithmic traders have kind of evolved from the systematic methodologies. Since most technical trading techniques can really be reduced down to a mathematical model, they can also be used in computer programs. So these programs can monitor price in replacement of a human, using programmed equations to sort of make trading decisions and then managing the results of those trades. The use of computers in trading has become increasingly widespread over the years, especially with the move towards electronic trading. So because of that, a product of the increasing power of computing and programming is used by both institutions and small retail traders, though the sophistication of the analysis and the software development of computers can be vastly different, obviously because of budget capabilities. So when we think about algorithmic trading or using a robot or an expert advisor, it's always important to look at the idea that it is not a trading replacement or a trader replacement. In fact, it is just simply a tool, and it still requires a human element to know what's going on. So sometimes, especially if you're new to the market, you might see the idea of a robot to do some of the trading for you as being enticing. But the reality of this situation is that unless you are monitoring what is happening regularly, then you can end up in trouble very quickly. Now, the next type of trader to sort of consider is something that is called using fundamental analysis. And fundamental analysis doesn't actually require a chart. Instead, what we will tend to do is examine the underlying factors that affect price and then form a theory about whether the instrument will become more or less valuable over time. Once that theory has been formed, it's possible to compare the theoretical value to a real current value. Then, as traders, we make an assessment about whether the current price represents a good opportunity to enter the market or not. And sometimes this might equate to being, is this product valuable at this point in time? Having formed your theory about where price is likely to head, us as fundamental traders, you'll aim to sort of take a position and hold it until the fundamentals of that situation has become unfavorable. So by extension, to put that into the world of today and what is really going on in the scenario that we see, we have the idea of what is happening on a macro and a micro sort of a level. What is going on within the economy that might influence the value of a currency, a stock, or any other market for that matter. Usually the easiest ways to sort of do the comparisons are to really think about the economy as a giant business. So if you are to be transferring or exchanging for the currency side of things, you need to sort of think of that currency as your ticket or your stock and your investment into the country that you are specifically looking at. Naturally, whenever we do deal with currency pairs and not actually the physical realm of it, there are two economies to compare. So you have to compare one side, let's say the Australian dollar, to the other. So you'd look at the Australian dollar versus the US dollar. And you would say, why is one side weaker than the other, or why has one side got more value than the other? And the same can be done when it comes to stocks. You would look at the idea when it comes to your equity markets as to what is going on in the world at this point in time. The easiest ones to start off with are tangible items. So if you were to think about oil, WTI oil being one of them, we know that we've had some pretty big drops in price recently, and the reasonings behind it, as opposed to looking at the charting side of things, we can think about the idea of what's actually gone on in the oil world. We've had massive oil cuts occurring recently, but before that, there was a price war where they were pushing the price of oil down and flooding the supply of the market. Unfortunately, they did it right in the middle of a global pandemic, which equated to the value of oil going right down because there was an oversupply. And then we had demand dry up. So there was no one flying planes, there were no boats traveling around, there was no need for a huge amount of oil. And eventually that led to an over storage situation where it was costing them money to keep that oil. So therefore, the price of oil dropped even further to a point where it became negative, meaning that they would pay you to take the oil away from them so that they had more room to produce more oil. Now, there are other methods of approach when it comes to trading, and one of the other ones is social trading. And social trading is perhaps one of the newest approaches, and its results are still what I would consider to be unproven. The idea is that price will generally flow in the direction of most traders. So for example, if there are 1,000 traders and 700 have sell orders and 300 have buy orders, then it is more than likely that the price will fall since there are more sellers than buyers. The social trader is aiming to follow the group and trade with the crowd. This approach tends to move against the conventional wisdom that trading with a group leads to a late entry, and subsequently, reversals against the position tend to occur. Another weakness of this approach is that it ignores the fact that the vast majority of markets are not all hooked up together in the same system. In other words, social trading systems only reflects a small subset of the market's current opinion. It doesn't have a big enough quantity or survey amount to really gauge what's going on. Commercial and institutional traders in particular provide the majority of trading volume, and they don't generally and wouldn't usually provide the information on where they're going to be trading, especially on social trading platforms. Each of these approaches will have their own advantage or disadvantage, but none of them have the whole picture. As a student of trading, it's really important to sort of expand your knowledge as much as possible across multiple approaches. And doing so has the advantage of being able to analyze the market in a less rigid manner. So, for example, a fundamental trader might decide to buy into the market, but then wait for the pullback for a technical level entry to try and get a better position. This would generally reduce their chance of drawdown and maximize their profit potential. When we have that sort of scenario going on, we consider ourselves to be hybrid traders or rational traders because we are trying to blend the best of all the elements that we can use to analyze the markets to try and give ourselves the absolute optimum opportunity to try and get into a position. Naturally, it doesn't always work. And sometimes you might find that you will have one set of analysis that won't quite fit into the spectrum compared to another. And so what you'll end up with is a series of analysis, a paralysis by analysis, which is a term used to say that you have got so many different ways of analyzing it and they're all competing with one another that it leaves you in a situation where you're not quite sure which one is the right way to go. So it is really about exploring all of the opportunities that are at your feet and considering how they might actually impact your trading and finding what actually works for you. You're not going to be able to replicate what I do or what the person next to you does. Instead, try everything so that you can work out what generally works best for you. So the next part of this that I'm going to be covering through tonight is all about the charting side of things. And if you are new to trading, then this is going to be an opportunity for you to get a little bit more intimate with MetaTrader 4 or MetaTrader 5, or perhaps even some of the other charting softwares that are available to you. So the first thing I'm going to go through is we're going to have a look at the different types of charts that actually are available to us, just from a standard features point of view. The first one of which is the line chart. We're then going to move into the candlestick chart and then the bar chart. And at the end, I'm going to have a bit of a discussion or talk about what some of the other custom sort of size of charts that you might want to have a look at are. So the first thing to sort of take note of is that regardless of the chart, you generally have the same X and Y axes, with the Y side being your price value and the X being time. A chart is simply just a graphical representation of an asset's price over time. It's nothing more, it's nothing less. It just gives us a way to actually visualize what is going on with price over a period of time. Some of the other charts that I'll mention a bit later on might replace the idea of the time side of it as a variable to become about volume, in which case you are simply looking at how many trades are actually occurring at that point in time. But you can't always get that data, so time is a pretty good replacement. The first chart that you've got on your screen that you can see right now is what we call a line chart. And line charts are quite easy to use. They are generally used over a much longer period of time. And they do tend to be a continuous line. So you don't get the gaps in price and you don't get anywhere near as much noise, which is something that we'll talk about in a couple of minutes. Now, what the advantages of using something like a line chart is, naturally, they do display it as a continuous line, so it is easy for you to get a handle on. It depicts an asset's closing price only, so you won't get much of the other data. It is restricted on the amount of data you get, but it does give you an idea of reducing that paralysis via analysis that I spoke about earlier. So if you're new to trading, this might be a good way for you to do it. Takes out some of the noise, allows you to really focus on what's happening in the market. Now, it's a common time frame for line charts to be used on a daily perspective, and this goes back from a bit of an age-old thing. pre-electronic trading, you would actually have to get your prices, mark up a piece of graph paper, and put in a dot plot for each of your individual prices that you saw on a daily basis. And so eventually you would start building up a chart. If you were new to trading, it might take you a couple of months to really get enough data for you to actually analyze it. When it comes to it today, naturally electronic trading has sped it up and we can change those time frames. But regardless of that, you still tend to find that the line chart gets used on a daily time frame, and meaning that every single new price point will be put at the closing price of that day over a 24-hour period. And it also generally sits well with stocks or longer term investments where you might be considering to hold on to it for a much longer duration than what you would on a commodity or in currency where it might just be in a singular day. The next type of chart we're going to be having a look at is a candlestick chart. And all the charts I'm showing you tonight are all of the exact same moment in price on the exact same index. So what we see here is the exact same thing as the one that we had here before. It is just now a very different form of how we can actually gather data. A candlestick chart actually gives you a little bit more information than you do on a line chart. In the line chart, I was saying it was only providing you with the close price. In a candlestick chart, you actually get a lot more information. Each one of these sort of bodies that you've got in front of you on your screen now is what we consider an individual candle. You can change the colors of them to fit in best with what you require. A downside move will give you a red candle. An upside move will give you a green candle if they're the colors that you decide to choose. If you look at the wick where I've got it labeled, the wick is what represents the highest point of price that has been achieved in the time frame that you've got selected and the lowest point in time that it's got. When it comes to the body, you will have either a close or an open, depending on whether the candle goes up or down. So it really does give you that much more information. You've now got a high, an open, a low, and a close to consider. And therefore, when we do look at these sort of charts, we try and identify patterns in them. When it comes to the idea of candlestick analysis, it looks at the idea of individual candles and their relationship or their movement prior to the one before. And it will generally give you some opportunities for the smaller time frame trades than you would usually expect. Now, whilst you do see a lot of patterns on a candlestick chart, you can still see them on a line chart. You just don't see them all. You tend to find a grouping of patterns to occur in one place as opposed to the individual price fluctuations that you might see on a candlestick chart. So just to recap, in this, you get a lot more information. You have the high, the open, the low, and the close. Now, moving on to the next type of chart, this is what we call a bar chart. And it has almost the identical information that you get with a candle. And it just makes it a little bit harder to identify the pattern sometimes because they are quite simply a line. Having said that, you tend to find that on algorithmic trading approaches, this will be the most commonly used chart because the algorithmic side of things is really not focusing on what we see as an individual, but what is actually going on in price at that particular time. And obviously being mathematically derived, it's just a way for us to keep an eye on what is actually going on. The idea of it is that it does still give you that same sort of information. We see that it has a high, it has a low, it has an open, and it has a close. It just replaces that body with something a little bit different. So this is really just another way of graphically representing it. Now, there are a number of other ways that you can actually look at a chart and consider how it is going to have a look. These are some of those, and these type of charts use volume charts. And so the idea is here that they replace the time side of things with a volume side of things, in which case you end up with tick charts, which literally display every single price movement that you can find. They require a lot of data and they take quite a significant amount of time to load. And in some instances, in order to have perhaps a year of data on a single currency pair, it might be the equivalent of about 60 gigabytes of downloaded information for you to actually be able to price them out. And they do use this movement based on activity as opposed to time. So if you don't see price actually moving, it's because there's no price movement occurring and it won't record a new bar until after that point. Range bars work in a very similar sort of a fashion, but range bars have the plan behind them that they will actually look and move towards a particular price amount that you set. So if they look just like a candlestick, then instead of moving over a time period, they will move to a predetermined amount that you can select. So let's say that is 5 points or 5 pips if you're looking at the FX markets. It will then only, if you set that as the target, it will a new bar will occur every single time 5 pip moves. The next one are Renko charts, and they very much work in a similar fashion, and Heikin-Ashi charts as well. They both have this idea of looking at the movements of price as opposed to the time frames of price. So it is useful for you to have a look at and see where they might go. These are a little bit more advanced, so if you are new to it, I would stick with the earlier ones to consider. Now, if anyone has any questions, I would implore you to ask them about now. The next phase of this, I am going to open up some charts and see if we can find a couple of ideas of patterns in current price, or if not, just so I can show you what we're talking about on the technical side. So I appreciate that me talking for an extended period of time could be quite difficult without actually visualizing what I'm talking about on the real world. So if you do have any questions, I'll give you about 2 or 3 minutes to put them in. And if not, we will move on to the next steps. Okay. No one seems to have any sort of questions, so that either testament that I am teaching quite clearly and easily, or you can always get to me later, and at the end of this sort of webinar, I'll go through some ways that you can actually get in contact with me in case you do have questions later on after you've digested it. So the first things to sort of take note of on this chart here is that at the moment it is currently a candlestick chart, and you'll see I'm hoping you can all see where my mouse is. Just above where the crosshair is now, you can see the line, the button for bar charts, so it switches it across. We then have the candlestick chart that occurs here, and we have the line chart. Now, the easiest one to sort of see straight away is that there are patterns all over the place depending on the chart that you're actually using. And when I spoke of the indicators, these are the sort of things I'm talking about here. And an indicator will average out what price is actually doing over a predetermined period of time. And that will help to try and give you a little bit more information than what you've already got so far. So let's have a look at the way that we might be able to find some patterns in price and what might actually happen. So if you were to be considering trading, then the first places that I talk about when I say these patterns that occur in price are ones like this. We have a run down here, we have a run up, and then we have another run down, and then it moves back along in the direction we want it to, which is up. Now, from here, it doesn't look like much, but at the reality of it, it kind of looks like a W pattern. And this is known to be what is a double bottom. The opposite side of this is known to be a double top. If I flick the chart across to be a line chart, it becomes a little bit simpler. I'm just going to remove that indicator to sort of give you a bit more of an idea to see what I'm talking about. And you'll be able to see that it does kind of resemble that. Even though it's not perfect, it does give an idea. And this sort of a pattern gives you an idea of the support and resistance side of things. It then also gives you an ability to sort of have a look at the candlestick recognition. So what we're really seeing is a level of support being tested, which would be this first one here. The next place that we're finding it is we're getting another support level being tested, a resistance level being tested at the top. When we have a failed reach of support, which means that this area here has not been touched again, or it has been tested and bounced away, then we likely can say that we can move to a new area or placement for where we might put a trade. And that next place is we need to consider what happens at the resistance line. And now the theory becomes, I don't believe that price is going to go further down because it has a failed support line. But now we're going to see if it is going to actually continue in the direction we think, which is the resistance side of things. We want to see this resistance broken. The best way to really think about your support and resistance is like the floor and the ceiling. The floor is your support. It stops you from falling into the ground. And the ceiling is above you, or the resistance that stops you from jumping too high. So here you would consider placing a position somewhere in this area. You would run a stop loss at this point here, and you would trail or wait for your price to reach up until you got to a certain point. Regardless of the chart type that you're looking at, in this instance, because it is a grouping of candlesticks and it also appears on your bar chart, it then appears on your line chart as well. If you were to look for individual candlestick sort of pricing, then you may not actually find what you were looking for at every single circumstance. In the end, I'm going to try and find something here for us live net sort of now that will give you an idea of what I'm talking about. Now, the first sort of things that I'm looking for here, I'm looking for big candles like this one here that's occurring right now. So we have the big wick at the bottom. It indicates that price has gone down much further than it would expect to, and it's been retraced back up and held off for a bit. But it shows that there's likely to be weakness moving forward, which is exactly what's happened further down. It's actually moved price down, and eventually it's pushed right through. In a line chart, you don't see that at all. You can't see where it's actually gone to. You can't see that this next move is a potential to happen. It simply gives you the close price. And you would say, well, it's now in a trend, and you'd have to be identifying off your swing low here, your next swing low here, and then your next one there to sort of really identify the direction it's going in. But whilst it's in the candlestick chart, it enables you to see that price has actually had a bit of a tumble and that it is likely to continue moving forward. So these are just a number of the ways that you can look at things. The technical trader who might use indicators will look at things a little bit differently. And they will generally be a little bit easier to sort of develop some of the skills with. And you might use these sort of indicators to start off when you are first getting into your trading. Now, what they will look for is particularly being a series of events in the chart that might occur and where they think they might see it. So here's one here for you now I've got. And this is just two simple exponential moving averages, both with a time period of 5. And they have been given a different setting for the price. So one is fixed to the close price, while one is fixed to the open price. And the technical trader would usually look at this and go, okay, well, we're going to try and find opportunity. Every time the red line is on the top and we get a clear break above and prices below, then we can look for a short position. This sort of thing works quite well in trending markets. And when you are new to trading, it gives you an opportunity to start practicing those candlestick reading skills, some of the other charting types, and to start thinking about how the fundamental analysis might actually work. So the easiest way to sort of get started with it is to use something this simple, and then you can sort of start to see the other metrics that are behind it. And it takes a little bit of the guesswork out of there for you. You've got a bit of a direction to work with as to where price might actually go, because it is simplifying and giving a bit of an average direction of price for you in advance. So not a bad place to sort of start. There are a variety of other sort of indicators that can be used. You might use something like a MACD, which is a moving average convergence and divergence. And in this sort of an area, you will look for very different basic sort of things. You'll look for the volume side of things. You will be looking for a divergence between price. So a divergence in price will usually mean that you might have price on the top going up whilst the lines on the bottom down here will be heading down this way, in which case you would usually go with the idea that the oscillator is running in the correct direction. You can see just how many different types of indicators there are, and they will all do a slightly different thing. Some of the other ones that you might want to use that are mathematically based are things like Fibonacci retracements. And these Fibonacci is a mathematical sum that can be found anywhere pretty much on the planet, from seashells to grains of sands, all the way up to the way we build houses. So there is theory that because of that, its relevance and its constant repeating nature, that if there is any luck in Fibonacci, I like to have a look at it. But regardless of that factor, you are able to sort of see where price might move to. And it gives a resemblance of where you might expect a retracement. So in this instance, we've drawn it on a downside move. At each of these lines on the way up, it indicates where we might see a change in direction. Now, not always does it work through. It is, at the end of the day, just a line, much like a trend line or any other of the variations you may have seen. But it does provide you with opportunity to consider where price might move next. So if you were in this sort of range, you saw price moving up, then you might start looking for a short position in different places. But keeping in mind, the trend is always your friend. So there are a variety of other ways that you can consider it. The expert advisor side of things are what we were talking about when it comes to robotic trading. These are just standard ones that come with your MT4 list and will allow you to sort of have a look at things from a different perspective. When it comes to your fundamentals, we don't care about any of this sort of thing. You might use it, you might observe it, you might keep an eye on what's really happening, but the reality of the situation is that the fundamental side of things allow you to sort of look at it from a global perspective. It's the big picture, if you will. If you look at the technical side of things, it gives you a small framework to work with. Obviously, your scope for information is much less than what you can get out of fundamental analysis. And naturally, combining them all together is really the best opportunity for all. Now, that's really all I'm going to show you for tonight. I do have other webinars that go on that go into other subjects and categories that do get a little bit more complicated, but they are always quite interesting. So if you have enjoyed tonight, then feel free to join in. I do have a couple of other little things to sort of show you before we sort of hang up the cloak for tonight. Naturally, if you do have any questions, feel free to put them in now and I'll answer them quite quickly. Alternatively, if you have any further questions that you're not quite sure or whatever it may be, it can be related to tonight's webinar. It could be related to some of the videos that I post on YouTube, which feel free to check out. You just got to type in ACY Securities into YouTube and you will find some of the videos that I do on a daily basis. And of course, there are plenty more of these webinars for you to have a look at. Now, if you do have questions, shoot me an email at talktoal@acy.com. I do answer them quite regularly. If it's something to do with the market, sometimes I will even make a video and give you a bit of a shout out to say that I'm answering your question. So feel free to get in touch and don't hesitate at all. Either way, that's going to end us on and conclude us for tonight. I hope you have all enjoyed the webinar so far. And I look forward to seeing you all at our next webinar next week on Tuesday. Tuesday's webinars are always a live market analysis. So the idea is bring your own charts, come and have a look at what's going on. Maybe you just want a second opinion about a position you're already trading, or perhaps it's something a little bit different and you would like to get that second perspective from myself. I will always mark them up from a technical perspective, and if I know the fundamentals on the given market, I will talk my way through them as well. So I hope you've enjoyed it, and I look forward to seeing you next time. Bye for now.